It has been an eventful week for the UK economy, which came into Monday with gilts and sterling under extensive selling pressure and questions surrounding the future of Chancellor Rachel Reeves, now back from a high-profile trip to China. As bond markets around the world sold off, the UK found itself in the eye of the storm. The 10-year gilt hit its highest level since the global financial crisis, while yields on the 30-year paper reached their highest since 1998. That spelled trouble for Reeves's self-imposed fiscal rules. Capital Economics warned that high yields had put the Chancellor on track to overshoot her borrowing plans by almost £1.5 billion, potentially forcing her into more tax hikes or spending cuts, and therefore further eroding confidence. But I do wonder whether this retreat we've now had, thanks to global markets, has taken some pressure off, or does the domestic data from GDP to retail sales actually put more pressure on the Chancellor, suggesting that, look, the tax receipts are not going to be that strong and there's still pressure on her at this point?
It's going to be a struggle, isn't it? I mean, again, I like the point about the retail sales this morning. It's only taking 0.04%. That's the exact figure that came out from the ONS off UK GDP growth. Now, considering how concerned we've been, how much doom-mongering there's been about the retail sector, and I do take on board your earlier point, it's not adding to GDP, but certainly it's not taking away at the moment, which is a much better scenario than we've been painted by many.
And that's for December, when apparently we're still seeing the British spend fairly decent health. But you start to add some of the other aspects here for the retailers, where they're expecting a challenging year. They're facing the national insurance contributions, going up, of course, and the minimum wage. So you start to put more and more pressure on the sector. Do we start to see a bigger detraction in 2025 from retail?
Don't know, but I also think that the share prices, if you look at them across the board, I mean, there are some notable exceptions, but a lot of them have that factored in. You look at, as I have, the bellwether of the non-food stroke discretion at the moment, I think we both agree, it's become Marks and Spencer's. And Marks and Spencer's has lost, to the top of my head, about 15% from its recent high. It's now 335 odd. It was nearly £4.
Well, I think there was somewhat of a rude shock, but the question is whether we see more data over the course of this year and there's more reality checks coming.
But we're going to get a rate cut. And we might get, 2, 3, 4 rate cuts in 20 if the inflation figure remains tame as well.
How is that money used, though? Because don't forget, we've got a lot of UK mortgage holders rolling over from those fixed rates into a higher fixed rate environment. So is that money just automatically eaten up in higher mortgage costs?
Yeah. Don't know the answer to that. Hopefully, the UK consumption household balance sheet is in such fine fettle that they can use the money to spend. I don't know. UK markets. Let's have a quick look. Here we go. We're talking about UK assets as well. The 10-year looks fairly tame compared to where it was, 4.646. The pound, steady, unspectacular at 122. But what isn't unspectacular is the FTSE. Believe it or not, we've just hit record highs. I mean, it's been a real slog getting up here, but 84.59, there or thereabouts, is a record high for the FTSE. What's driven it this far? I would say a couple of factors. One of them being a bit of hope in the M&A in the mining sector, as Karen's been talking about. Two, the banks are getting a bit of a leeway from the Basel banking committees, bringing in the rules. The Bank of England saying they're going to bring the rules in a year later now. And three, I think it's just a bit of bottom picking. The markets globally are rallying. And as we mentioned, there's a lot of stocks in the FTSE, which, according to guest after guest, look fairly cheap. So valuation, the banks and the miners, and a little bit of activism on the likes of Smiths, driving the London market a bit higher.
Some dollar earners too before this?
Well, and the oil price. The oil price is, look at Brent now, 81.64 as well. And so you look at Shell, BP talked yesterday cost cutting, so a little bit of momentum.
Yeah, thanks to all those fund managers who said it would be one of the underperforming markets. They didn't hold up much hope for any returns.
Give it time.